Nebius Group just reported 454% revenue growth year-over-year, hitting $582 million in a single quarter. But in the same breath, the company posted a net loss of $190 million. So the real question is not whether Nebius is growing. It obviously is. The question is whether the economics behind this growth ever close. Nebius Group is an AI cloud company built around dedicated GPU infrastructure. It runs three consolidated businesses: Nebius AI Cloud, the autonomous vehicle platform of Ride, and the EdTech service 1010. The core engine is AI Cloud, renting high-density GPU compute to enterprises that do not want to route workloads through Amazon, Google, or Microsoft directly. In Q2 2026, that engine produced $582 million in revenue, up from roughly $105 million in Q2 2025. Alongside the earnings release, the company announced a $775 million senior secured debt facility, its first, priced at SOFR plus 2.5%, maturing October 2030. Management says that facility, combined with customer cash flows, covers more than 100% of the capital expenditure required to deploy the underlying GPU infrastructure attached to that specific deal. The headline number, $582 million in Q2 2026 revenue, represents the clearest confirmation that the AI cloud build-out is translating into real bookings. But the number that should sit alongside it is $40 billion. Nebius disclosed over $40 billion in additional contracted revenue already in place from investment-grade customers including Microsoft and Meta. That backlog is not vague pipeline. It is contracted. The company said it expects to raise more capital at terms similar to the $775 million facility, citing that backlog as collateral. Net loss came in at $190 million for the quarter. Operating margin, per the snapshot data, sits at an unusual 155% on a reported basis, a figure likely distorted by non-cash items, which warrants scrutiny of the full income statement. Here is the causal chain as Nebius Group has structured it. 1. Enterprise demand for GPU compute outside hyperscaler ecosystems is structurally large and growing. 2. Nebius secures long-term contracts with investment-grade customers like Microsoft and Meta before deploying hardware. 3. Those contracts unlock debt financing. The $775 million facility is explicitly backed by customer cash flows. 4. Debt plus contracted revenue funds GPU cluster deployment at scale. 5. Deployed capacity generates revenue, which services debt and funds the next deployment cycle. The model is capital-intensive by design, but the contract-first structure is meant to de-risk each tranche of spend. The bear case here is not theoretical. With a $190 million net loss on $582 million in revenue, Nebius Group is burning capital at a pace that requires the contracted backlog to actually convert on schedule. The $40 billion figure is striking, but its composition, timing, and customer concentration are unverified in the public data available. If two customers represent the majority of that backlog, any renegotiation or delay hits the entire financing thesis. Add NVIDIA supply chain dependency, GPU availability constraints could slow cluster deployment and delay revenue recognition even on contracts already signed. Hyperscalers are also not standing still. Microsoft and Meta are both Nebius customers and competitors in adjacent infrastructure markets. AlphaOS surfaced the $775 million debt facility filing from SEC Edgar, dated July 17, 2026, weeks before the earnings release, and flagged the $40 billion contracted revenue figure as a high-importance signal alongside the NVIDIA and Microsoft partnership nodes in the knowledge graph. The revenue trend classification came back as accelerating, with a coverage score of 95 out of 100 on Nebius Group. Nebius Group competes directly with CoreWeave and Applied Digital in the specialized AI cloud segment, companies racing to absorb GPU demand that hyperscalers cannot or will not serve at the margin. The NVIDIA partnership is load-bearing. Without preferential GPU access, the entire deployment model slows. Microsoft and Meta anchor the demand side, but both companies are simultaneously building their own infrastructure, which makes them frenemies at scale. The AI infrastructure industry cycle is classified as early recovery with strong momentum, meaning the demand window is real, but the competitive shakeout has not happened yet. Nebius Token Factory and the AI Factory model are additional surface area, but AI Cloud is the revenue engine that matters in the next 4 quarters. 3 things to watch. First, backlog conversion pace. Does the $40 billion contracted figure translate into recognized revenue on the timeline the debt structure requires? Second, net loss trajectory. If the $190 million quarterly loss is not compressing as revenue scales, the unit economic story breaks down regardless of top-line growth. Third, NVIDIA allocation. Any supply constraint or pricing shift from NVIDIA directly impairs Nebius Group's ability to deploy contracted capacity on time. Research and analysis only, not investment advice. Run Nebius Group yourself at AlphaOS.finance and surface the signals that matter before the next print.